Hello and welcome to the LTAM Asset Management quarterly update and in this situation year-end update. My name is Phil Blancato and I'm from LTAM Asset Management. This video will give you a short insight as to our expectations for 2016 and a brief recap of 2015. Well, to get right to it, 2015 was a challenging year. For those of you who have known us for a while, we talked about how 2015 was going to be a very volatile year and that there were a number of headwinds that were going to be difficult to work our way through. We had higher expectations of the stock market. We had modest expectations of the bond market. And our alternative exposure, we thought would add some excessive income to the portfolio. Truth be told, when we look back at 2015, it wasn't a great year. Asset allocation, the idea of blending asset classes, really didn't work. There were a handful of securities in the S&P 500 that did very well, and by and large, the rest did not. In fact, believe it or not, the top 10% of the stocks in the S&P 500 were up 14%. The rest were down 60, with the average being negative 4%. So you think about that type of environment, owning mid-cap stocks and small-cap stocks wasn't very effective. You really just needed to own large. And in large part, that's because in 2015, the headlines won out over the real fundamentals of the economy. When we look back, we saw that the consumer strengthened throughout the year, whether it was through the job market getting better, the fact that savings had increased, spending was modestly going up, and even wages ticked up a little bit. The consumer didn't really have as much of an impact in the economy as we thought they would. Remember, 70% of our GDP is driven by the consumer. When the consumer is healthy, we're healthy. But the reality is there were other things that held us back. Consternation around the Federal Reserve, whether or not they would or would not raise interest rates, caused lots of volatility in the marketplace. Fears in Europe, like Greece, lingered throughout the year, whether or not Europe will be a contributor on the global stage. And then ultimately Asia, China specifically, slowing down, and the ripple effects it really sent through the market. Still even feeling some of that this year. And then finally, the reality that oil, the idea of the oil and energy industry significantly going down would be a negative drag on the markets rather than positive. Historically, we see oil and energy as a boon, and that when gasoline and oil are cheaper, it's a benefit to 80% of the economy and not to 20%. Because of the cataclysmic drop, the real oversold situation in oil, it was begun so far to be a drag on the overall market, and it really held the stock market back. The bond market was a little bit different. The bond market was waiting for the Federal Reserve to grow, to actually finally start to raise the federal funds rate and maybe pay you a little bit more at your savings account. That finally happened in December of last year after long waiting for it to happen. The reality is, when the Federal Reserve is raising interest rates, it means the economy is doing better. The economy never really got to the point where the Fed could be really confident in it, so they finally got around to doing it in December, but the reality is it's probably not going to be a lot of raising of rates this year, as the economy, while doing okay, certainly isn't going gangbusters. So in the fixed income market at this point, being conservative is smart. There is a thought that inflation might go higher as interest rates go higher and as energy slowly goes higher, if it does. But more importantly, the fixed income market, after a 30-year bull market, is in a sort of a slow growth winding down phase. In our portfolios, we're earning pretty good yield, over 3% in most portfolios, but being very conservative in nature because a slight rise in interest rates can have a pretty negative impact on the bond portfolios. The bond market in and of itself is going through some changes. In the next few years, what the bond market looks like today probably won't look like that in a few years from now as interest rates go higher. The international stock market was a little bit more difficult. QE, or quantitative easing, is taking place in Europe the same way it did in the United States. They're really going through this cycle and so far hadn't shown a lot of fruit. So international allocations didn't really help the portfolios either. At some point, we think Europe will start to turn around and grow more quickly because of lots of free cash in their system. Unfortunately, it's not helped yet, and they've got some ways to go before it actually has a profound impact on their economy. But we do have high expectations for Europe going into next year, as we think they're going to start to turn the corner because of so much federal stimulus. And then finally, the alternative allocation in our portfolio was somewhat lackluster. We had an allocation to different types of fixed income and energy related securities that really didn't perform well. They added great value from an income standpoint, but as the energy market corrected, we saw some value lost in those securities. We no longer hold them in the portfolio. In fact, we have a fairly large allocation to cash right now as a hedge against volatility early in the year here. But by and large, our alternative allocation didn't help us last year, and we're going to change the way we manage our alternatives going forward, using more securities that'll help protect in case markets stay volatile in this situation. So to wrap up, 2015 was a year that asset allocation did not work. You were really just better off owning a single asset class. But remember, the reason why you stayed diversified is not when markets are going up. It's when markets are going down, significantly down, like a 2008, to protect your portfolio. We're somewhat optimistic about 2016. While we don't expect a year of exceptional return on stocks, presidential years usually have a 6% average annual rate of return. They tend to be relatively boring, especially the second half of the year. There's going to be plenty of volatility in the first half. Things should mellow out as we get into election season when the focus is on Washington and less on the economy and the stock market. Add to that, the bond market's probably going to be relatively benign. The Federal Reserve is going to have a tough time raising interest rates aggressively, so what we have today in the bond market will probably look a lot like this at the end of the year. And our alternatives, leaving energy behind and real estate behind, having a focus on absolute return, generating income without a lot of downside loss should help support the portfolio. To wrap up, thank you very much for your confidence in us. We appreciate your time. If at any point that we can be more of a service to you, please contact your financial advisor and we'll gladly walk you through what our 2016 themes are, other ways that we can help you better explain your current portfolio or what we think of the overall economy. Thank you and have a wonderful 2016.